in 2009 when I took my APC at Colliers, November 2009. I passed my APC and went from a graduate surveyor to a surveyor by virtue of passing the APC, and then was immediately placed into a redundancy pool because the job of surveyor was being made redundant in the team that I was in. So I was there 10:30 a.m. celebrating my APC success. By 11 p.m. I was in a room with HR facing a redundancy panel. I mentioned earlier the potential return of the big box and it being in focus. And whilst, of course, today investors would prefer a deal volume of 30 to 50 million, and they may not be able to get themselves comfortable with 100 million that you may require for these bigger boxes. But they, for me, have operational efficiencies for the underlying occupier and actually deliver great income over a prolonged period. And I think we're going to see less supply over the next 10 years than we've seen in the prior 10 years.
Welcome to the People Property Place podcast. Today we are joined by Alistair Ennever, Head of Europe at Vestas Investment Management. Established in 2010, Vestas Investment Management invests capital raised from single or multiple investors into global real estate throughout Asia, Europe and the Americas. It does this through a variety of products that target core plus, value add and opportunistic returns by investing in office, retail, hotel, multifamily and logistics assets. In Europe, they focus on office and logistics. Alistair set European business up in 2022 and is responsible for managing a portfolio valued at more than 3 billion euros. He was previously head of Industrial and Logistics Europe at Savills Investment Management and has worked at LFF Real Estate Partners, Chapman Petrie and Colliers. And it gives me great pleasure that he is here today. So welcome to the podcast.
Well, thanks for having me. Good to be here.
Not at all. Well, look, I'm really excited to find out a little bit more about Vestas, how you see the market, where the opportunities are and how you've done what you've done. But a question before we come on to that I ask everyone on the podcast is how and why did you get into real estate? Because if I'm not mistaken, you left Oxford Brookes University having done real estate management at the perfect time of 2007. How did you, you know, before we kind of get onto that, how did you kind of select real estate or why real estate?
Obviously a good question and hence why you start there, I guess, every time. For me, I had a godfather who was in real estate. And I went and did work experience with him whilst at school, you know, a fresh-faced 16-year-old, seems like a very long time ago, and enjoyed that working experience with him and his property company. Thought this was great. The guys were out for lunch quite regularly, enjoying socializing. There seemed to be that element of it, as well as, of course, the sort of tacit asset that you can touch and feel. So real estate was kind of, for me, versus, you know, just pure numbers and so on a screen, like in a stockbroking type environment, which my father did. And so I pursued the real estate path, wanted to go straight into it before university.
Really?
Yeah. But my mother said, no, you've got to go and get a degree. She got one. And so she was absolutely determined that I got one too. So went and did the Oxford Brookes course, and then, of course, was advised that the likes of Colliers, where the journey began, was the best place to get the real estate grounding and so on. So that's where I made that transition to those sorts of businesses.
So is your godfather a developer or an investor, or which part of the real estate kind of ecosystem did he kind of work within?
He was an investor, ultimately. He had varying businesses across the time, but one of which was Pillar Properties that became, and then he sold that, and latterly London and Stamford, which then merged with London Metric, and so on. So he had a good history and track record.
So you were desperate to kind of get in.
Yeah.
Within that space, or kind of an estate agency route if you didn't have the degrry, or which?
No, I mean, like I was actually going to go and work for him from the get-go. Yeah,
fine.
Which would have been awesome. But of course, my mother's right, as is often the case. I can say that publicly, which she'll like. It was good to go and get the grounding and go from the grassroots up. I think, it probably might have served me well in the short term to have a job, but maybe longer term, you might have lacked some skills and some gaps and so on. So,
and also build the network and
exactly
wider benefits that come from doing that.
Definitely.
So you graduated in 2007.
Yeah.
Were you one of the few people to land an APC seat at one of the surveying practices, or had kind of the world not started to fall apart at that stage?
Exactly. I think we were basically the last intake, 2007, and experienced actually quite a bizarre story. In 2009, when I took my APC at Colliers, November 2009, I passed my APC and went from a graduate surveyor to a surveyor by virtue of passing the APC, and then was immediately placed into a redundancy pool because the job of surveyor was being made redundant in the team that I was in. So I was there 10:30 a.m. celebrating my APC success. By 11 p.m. I was in a room with HR facing a redundancy panel.
And did you know that to be the case?
No.
You had no idea?
I had
so
no
it's not
idea.
like you could even try and gamify it and fail your APC to keep your job and line it up for a reset in 6 months' time or something?
No. My boss at the time also didn't realise that would be the ramifications. And he just had his head in his hands too and quickly took me to the pub to drown our collective sorrows. But anyway.
So you were made redundant?
Well, fortunately, I avoided the redundancy in 2009, but I was in the pool.
Oh, you were in the pool
Yeah,
of it?
Exactly.
How did you escape that one?
I think there was someone who actually probably wanted to go. And so they were the one that effectively then solved the issue.
So did you rotate through various different APC rotations at that time, or were you kind of embedded in?
So you sort of had a host department, and for me that was in property management, occupier property management. So that's broadly where I was for a couple of years. But of course, I rotated out to get my time in valuation and L&T. But really, I spent the majority of that 2-year period in property management.
And was that kind of broad sector, or did you kind of start to specialise?
At the time, it was primarily retail, actually. So high street cancer research shops was what I was looking after from the occupier perspective. So certainly not glamorous, but very good grounding and a required service, I guess.
You touched on from an occupier perspective, because a lot of management is from a landlord perspective. Just for that distinction, can you just explain what the difference there is and how, why is it different looking at it from an occupier perspective?
Well, I guess, of course, if you're negotiating new leases, you're doing it from the other side of the table. But of course, if you're a retailer, often the case is you've got a lock-up shop and you've got some upper parts, which may be included in your lease. And therefore, that gives you a potential liability, actually, of managing a subtenant portfolio. Say, for example, for cancer research, you'd have the shop on the ground floor and you might have 2 flats above, which then you would have to lease on ASTs and so on. So having a managed subtenant portfolio was one of the other differences, I guess, from that point of view. And again, not particularly necessarily glamorous, but a very good grounding.
From there, how did your role evolve, and what did you kind of move to within Colliers?
Yeah, so I always wanted to move towards a more investment focus and so on. And in order to do that, I knew I had to take a couple of steps, also because of where the market was at the time. And so I went and did valuation, moved internally, managed to secure a move internally at Colliers. So I did valuation, mortgage lending valuation for about 1.5 years, 2 years. And then I knew I then had to make the next step, which was towards Chapman Petrie and into actual investment agency.
So at that time in the market, lending or valuation, rather than being on a quarterly basis, has probably moved to being monthly, right?
Yeah.
So actually it's a shrewd move in terms of job security, just the sheer quantum of work and fees being generated, but also probably what just sharpened your investment eye to kind of work out what a good deal is, what a bad deal is, and maybe how the banks look at things. So to make that move into investment, you've done some more reps in the gym, as it were.
Yeah, absolutely right. I couldn't put it better myself. And that was entirely the motivation. The only other bit I would add in as to what experience it gave one is how to, or the type of questions that borrowers were typically asking you as the valuer on behalf of the lender, and of course what it meant and the implications for their equity. And of course, that is now being borne out again this time around. So I've seen some of those negotiating tactics from borrowers and so on, and how valuers have to respond. So we know that sort of element of it. But it was certainly an interesting time. I don't think, hopefully, not to be repeated.
It's interesting. There's some people who actively seek out a valuation move, as you did, to sharpen that investment view. Maybe because they've got the personality to thrive in investment, and there's others who kind of just fall into it and stay in it, and they kind of make a career of it. How easy was it to get out of valuation and move to an investment role? Was it part market, part timing? Tried to push that door internally, but because you'd moved into valuation, you're kind of typecast as a valuer, and so the investment team didn't want you. How did you kind of manage that?
Well, yeah, you're absolutely right. Like internally, also, it was a bit of a fiefdom, typically in the bigger agencies, and when I guess the menu was relatively starved of deals, there was very little opportunity for new people to sort of break into a team, and hence why I looked externally. Really, and tried to play to the point you make about possibly playing on personality being akin to being involved in that world, but with the grounding of both, property management and some valuation. That was the bits that I tried to argue with the let's say the game changers, or that gave me the platform of foundations to learn, and that was very much the intention and what I was fortunate enough to learn from at Chapman Petrie, some very well established and good market operators in a niche business, who had time also to give to me to try and help me learn the craft. That's how I went about it, I guess.
So someone who hasn't heard of Chapman Petrie before, can you just, who are Chapman Petrie? What do they cover? And kind of what was the role that you kind of went on to do? Yeah,
well, so Chapman Petrie, founded, quite some time ago by two individuals, obviously a Chapman and a Petrie. And they had both a valuation side. So David Chapman was a valuer, and he used to value a lot for the Cadogan estate and so on. So he had that sort of, let's say, the repeat income. And then Piers Petrie was very much a investment agent and broker, and did a lot of deals over his time. So you kind of had the good combination of the two. Obviously, the business evolved over a period of time, and some other partners came into it, and they built out a property management team, and so on. So it was a small business, about 12 people in total, typically, whilst I was there over the years. But with a niche investment focus, or a niche investment agent, but with a UK focus on all sectors. It was really just deal oriented.
And so you were brought in to work with Piers on the investment side of the business?
Yeah, Piers and the other partners in the investment team, exactly. Yeah, to sort of support them as much as possible. They saw me as having some number skills from valuation times and so on. So that's really where I started anyway.
And were you? Can you just talk to me about the kind of the types of deals you were doing at that stage, and the lot sizes on behalf of whom?
Yeah, first deal I did on my own, as it were, was for AEW. It was a shop in Chester that we bought for 1.45 million, I think, at 11% yield back in whenever it was, 2012, 2013, and that was the sort of the first one. And then we ranged all the way up to involvement in an office building on the M1 for Threadneedle at about 65 million. So there was a decent range, and one of Chapman Petrie's legacy clients was the NFU, and they were retained for a period of time on sales and in some cases acquisitions as well. So I got quite a lot of exposure to the NFU as a sort of institutional investor in the UK market.
Doing both acquisitions and disposal work as well.
Yeah, exactly.
After kind of three and a bit years, you left Chapman Petrie and you went to LFF Real Estate Partners, which is a French business. How did that come about, and why did you transition from the advisory side to the principal side?
Probably make no secret of it. The ambition was always to get to the investor side in some guise. And of course, as I said earlier, knew I needed to A, get the grounding, and B, just take some steps, which had to evolve given the market and where it was at the time as I was sort of growing up in the real estate market. And to move to LFF, they actually were trying to raise at the time a shopping centre fund. And there was an opportunity to be a sort of assistant or part of that shopping centre fund. I thought something new, investor side, discretionary capital, that all seems sort of add up. And also with the backing of La Française, who a very well established and an enormous French investor with French retail capital amongst their client base, I thought that would be a very good way to start. Unfortunately, the shopping centre fund never actually launched, and fundraising very challenging still at that time. But what did start to emerge was the separate account business, and that's where I first encountered overseas investors, including Korean investors.
So, for someone listening to this who doesn't know what a separate account is rather than a fund, can you just explain the difference there? And it's probably a good thing that shopping centre fund never got off the ground. Right?
Yeah, indeed.
Benefit of hindsight.
Yeah, indeed. So the separate account or managed account, like everybody has their own particular
sidecar.
name. Yeah. Everyone has their own name for these things, right? But in effect, it's a non-discretionary mandate where you're in an advisory capacity to the ultimate equity. And you may do that on a one-off deal. You may do that with a programmatic type approach, but it's not in a fund vehicle where you have predefined guidelines or terms for a fund.
And why would a business want to set up a sidecar or a separate account?
Well, I guess it's more actually for the investor. Because the investor themselves gets to dictate or determine the strategy or have more influence over it. Whereas once they've invested their capital in a fund, it's then at the discretion of the fund manager as to the acquisitions and deals bought. Whereas in the separate account, non-discretionary setup, the investor has a greater control.
And I guess it works both ways in the sense that you could find the deals and then go and find the capital and form a side venture or a separate account, or the investor comes to you and says, we want you to be the manager of this. This is the strategy. This is what we're thinking.
Yeah.
Agree fees or whatever it might be. Go and do it. It works both ways, right?
Yeah. I mean, you're absolutely right. It should work both ways, but in my experience, at least, it's typically you as the advisor seeking out the equity and showing opportunity, your service, what you can bring to their investment program, and so on.
So you touched on it was your time at LFF that kind of gave you or broadened your client base or institutional exposure or geographical base. Can you just elaborate on that? And who you were talking to and also maybe what the mindsets and the nuances of these different types of investors are? Yeah.
So, I mean, predominantly at LFF, we were focused on, as I mentioned, Korean investors and some Hong Kong investors. There were some relationships that La Française had that we were then to try and develop, but also historically LFF was Cushman & Wakefield investors, and they were bought by La Française as their UK investment manager from Cushman's back in whenever it was, 2013, 14, I think, from memory. And so they had an existing platform. They had done a transaction with a Korean investor in 2012, I think, which was a London asset, 30 Crown Place, which was an office building, one of the first Korean investments in London outside of the bigger MPSs and KICs. So that was sort of the start of the Korean investment into Europe. In fact, they'd done some things in Europe, in the US, but in Europe less so. And that was sort of one of the main investor bases that I got exposure to at that time. And in fact, the two individuals I work with now most closely at Vestas were at Samsung was the investor then. They were there back in 2014. That's when I first met them.
Interesting. So they were the equity, and you were kind of the manager trying to do deals on their behalf. And
Yeah.
did you do that office deal, or was that a
No,
case of
it was already done.
it was already done?
Yeah,
But you got exposed to building the relationships with the Korean
Yeah.
kind of capital to go and try and source deals that kind of match their
Yeah, do
criteria
the
or their
next one.
appetite, as it were.
Exactly. Yeah.
So you were with LFF for a couple of years before moving to Savills Investment Management.
Mm-hmm.
Why did that change come about, and what was the kind of the reasoning for that?
Yeah, the challenge with the that we found that, or at least I thought the challenge was at LFF, and they've gone on to do great things. So maybe my perception was misplaced, but the challenge I found was that you needed a wider research support, and you needed a bit more, let's say, critical mass in order to help these overseas non-discretionary mandates and give them confidence that you were the right manager for them to partner with. And at La Française, that was slightly lacking insofar as it was newer, had offices in Germany, France, obviously, and the UK. But with Savills IM, they had a much wider office network across Europe, as well as offices in Asia, close to the investor base, and the research function and everything else that goes with a larger organization. So I just felt that if I was going to do the separate account, the managed account type work, you needed to do it in a place with a larger platform. Yeah,
and all the back office functions to enable you to kind of focus on the higher value tasks as well that come with it.
Yeah.
So you moved to Savills Investment Management. You left there as head of industrial and logistics Europe. What role did you start there in?
Yeah, so I started as a transaction manager, effectively just overseeing new acquisitions on behalf of separate accounts. And the accounts I was working on, the investors were Malaysian and then latterly Korea. So I sort of started managing logistics acquisitions in the Netherlands on behalf of Malaysian investors was the first thing I did pretty much at Savills IM. And that evolved. I did some office transactions. Was involved in a retail transaction. And then as we sort of, let's say, stabilized one or two of the Malaysian investors, I was tasked with, next chapter together with colleagues was to try and crack the Korean investor base and do effectively a repeat model of what we'd done with the Malaysian investors.
So just to expand the book of business, expand the contact base, and South Korea was a kind of a market, or there was an appetite to deploy capital out of that into the UK and Europe, and go and business develop that, build relationships, and do some further work.
And to continue to answer your original question, which I did a relatively poor job of, was how I ended up at specializing more in logistics. Was that with the Korean investors, we predominantly did logistics investment, and of the things we did with Vestas, we acquired about 1.5 billion euros of assets over a 4-year period. And there were about 15 assets in total. And of those, 12 were logistics assets and 3 were offices. And that just led me in the direction of more of a logistics focus and specialism, as well as part of those 12 assets that we acquired for Vestas were in more of a fund type structure. So then one was leading towards a sector specialism / fund management role in logistics. And Savills IM is a big logistics investor across Europe, not just from separate accounts, but also some specialist funds run from Germany. And so there was a need for someone to oversee that area of the business, and Savills IM was moving more towards a sector specialism setup as well.
And I guess as you do build relationships with the type of capital rather than doing, one-off deals, programs and more kind of themes. And as the kind of the trust relationship build, it kind of makes sense to then, as you say, set up more fund type structures where they're the only equity in their particular fund, but it's all defined in terms of the returns and the types of assets that you kind of look for.
Yes, exactly. And the problem, or one of the problems that we were facing with, particularly with non-discretionary capital, didn't really matter where it was from, was that at the time, the logistics market was red hot. You go into a bidding process against open-ended funds out of Germany or wherever, where they have pre-raised capital for the deal. They can show you their track record. They can say they can do the deal in 4 weeks and so on. Whereas we had a bit more of an elongated process with, in some cases, raising the equity for a specific deal whilst you're in a process of bidding against others. And that's just gave too much execution risk to the vendors, quite rightly. And so, we had to find a way of gaining additional credibility other than just offering the highest price, that vendors felt comfortable executing deals with us. And that's how the fund concept of pre-raised equity came about. Of course, funds have been around forever. It's nothing new, but it was a new element for the Korean investors that they hadn't done previously.
Because finding the deals, raising the equity for the deal, negotiating the debt as well on it, there's too many moving parts for a vendor to take you seriously as a credible bidder or potential buyer, even though your price might be the highest. They might just want to get it off the books quickly without it being dragged and then having to go back to the market.
Completely. And the other element I should really have started with, but can finish with, is that we were concerned as advisors that the Korean capital or wherever it was coming from in one-off deals was not diversifying their risk exposure sufficiently. And so in a fund structure, we managed to raise 200 million of pre-raised capital of equity in our first fund. And that allowed us to buy 8 assets in 5 countries, let to multiple different tenants. Whereas historically, you might do 100 million in one building with one tenant in one country. And the risk profile for us as advisors was just becoming too great. And so the fund structure was one that we were pushing very hard to take our investors into.
Yeah, like a fiduciary mindset as well for their benefit too, rather than just it being closing deals, taking fees for doing it and not really caring about the business plan, as it were. Talk to me about how Vestas Investment Management, the European platform, kind of came about.
So obviously I started working with, as I mentioned earlier, met the guys in sort of 2014, 15, when actually they were at a different business. They moved across to Vestas in 2016 and pioneered Vestas' overseas investment management or investment program. And the guys worked with the likes of BNP Ream and Heinz, and of course Savills IM, where I was. And over that period, so we did our first transaction whilst I was at Savills IM in 2018 for Vestas. And then, as I mentioned earlier, the next 4 years, we did 15 transactions and quite a lot of equity invested. And so I had a very strong relationship with these guys who are excellent in their field in Seoul of corralling the capital and managing those relationships. So it worked very well. I thought and still continue to think that the team in Seoul is exceptional at managing the capital and reporting to them appropriately and so on and so forth. And then combined with a platform in Europe of sourcing and executing transactions, it makes a very neat combination. And of course, Vestas and the Savills IM relationship was working well, but why not have that in a, let's say, in a linear setup where it's all under one roof? The guys in Seoul can say that Vestas as a business is entirely accountable for the investment from the European end all the way back to the Seoul end.
So it's more compelling when they're talking to investors on their side?
I think so. And I think, if you were an independent third party, you would probably be able to get behind that standpoint. Of course, as I say, the relation, the setup with BNP Reem or Heinz or other managers works very well and continues to do so. But I think going forward, in a maybe more challenged market environment where accountability is key, I think it's a compelling story for the investors, and the investors, fortunately, have lent into that, and they believe the same.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People Property Place podcast, and that one small action really, really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. So you set the business up in October 22 or back end of 2022. Mm-hmm. Can you just give me a bit of an overview of the portfolio, assets under management, the locations and type of kit within it?
Yeah, so we have what you might term, and people, your viewers and so on, and listeners would refer to as typical Korean deals, which typically were very core, long income in new assets, be that office or logistics. So typically that is what we have in our portfolio. We've got about 24 assets, of which 18 are logistics and 6 offices. But in terms of value, the office and logistics are quite similar because those office buildings tended to be the larger HQ type buildings in the likes of, Berlin, Paris, we had London and so on, and they're larger deal volumes, whereas the logistics portfolio spreads from Poland in the east all the way across, continental Europe, and we've got one asset in the UK, but the majority of assets are all on the continent. But in either of those two sectors, and they're typically pretty core in nature. We've got one or two, I would term, slightly more core plus assets, a bit of multi-let, which is the direction we wanted to take the investors in, because these big boxes absolutely have their place. And in my opinion, that place is actually coming back to being more and more prevalent. But the multi-let nature of assets also allowing you to drive performance in a rental growth environment is quite a nice, blend. So
you have is it kind of what typical 25-year lease, FRI or index linked, upward only rents? So you've got 25 years worth of income. And then on the other hand, you can kind of blend that, as you said, with more, not a sticky income, but you can kind of move the rents on and drive the performance, so you get a different type of return. So just trying to get that balance with your kind of fund management hat on, right?
Exactly that, yeah. And that was kind of the approach that we wanted to take, rather than, as we alluded to earlier, the one-off deal, the fees, and move on. It was more about trying to blend a wider portfolio, even though you had different investors perhaps behind each and every, at least you then had a variety of the assets and their risk profiles. But of course, in the funds, exactly that. The two funds that we have, exactly that fund management hats on to try and blend out the risk profiles.
Who or the types of capital that invests or that investors raise money from, is that kind of blue chip institutional businesses, insurance, endowment funds, all of the rest of it from Seoul and wider Korea, but also high net worth and retail investors? What type of capital does the business typically raise money from and then you deploy?
So we're almost entirely from the institutions, the insurance companies or pension funds. There isn't any retail investors in our investments. Of course, other structures and so on have had exposure to retail investors, but Vestas hasn't. And so, it's your typical blue chip type institutions from South Korea.
Yeah, you touched on, and I guess people listening to this who read the press as well will see in the last couple of years or post-Truss, June 22 or whatever it might be, since there's been a little bit more volatility in the market, a lot of the Koreans, I guess, who've been managing retail capital have been severely burnt. I could try and explain what's happened, but rather than do that, I think you're probably going to be much better placed to do that, just in terms of how and why, and just explain maybe that situation for people who don't know or haven't been able to read the press or learn about that.
Yeah, I mean, I think where does one start? But I think it's probably worth saying, setting it in context. So, of course, from, I would say, 2017, 18, there was a real desire for Korean investors to expand their real estate portfolios outside of Seoul. And there were a number of factors in that, including, a currency premium to euro versus Korean won, and other things, diversifying out from having an entirely domestic investment portfolio, for example, is another. And, the US was a real market that actually Korea and the US have a lot of synergies. There are a lot of the guys in Seoul go to American universities and so on. So there's sort of baseball's their favorite sport, things like that. So they wanted to move not just out of domestic, out of the US, and Europe was the next sort of obvious target with that currency enhancement. So you put that in context, and then the risk profile was core in nature, and it was really a distribution play. So the guys were all just chasing distribution to pay back their pension holders and so on, a considered return of somewhere around 6% at the time. And that led to significant investment, particularly into the office sector, into those HQ type buildings, single leases, or maybe multiple, but not that many, not heavily multi-let assets, but long and strong income is how I describe it, either in offices but also in logistics. But logistics hasn't hit the press in the same way, perhaps because they're performing assets. Whereas what's come out more so is the offices where 10-year leases, for example, were bought on 5-year business plans. And so you were trying to sell assets at the nadir of value in the investment cycle of the asset itself, plus the double hit of interest rate changes and Trussonomics, as you referred to, in the UK at least, really having an impact on value. And that has led to those situations of being burnt. And what was happening also in Seoul in terms of the funding of those acquisitions was that because there was such a rush to get into the market, and it was a highly competitive time, 2018, 19, and so on, there were lots of investors in London office, for example, or Paris office, wherever it may have been. Companies in Seoul, known as securities companies, were effectively warehousing the acquisition of buildings and then syndicating the capital stack to underlying either institution or investors or retail investors. And they were getting paid a fee for doing so as well, warehousing the investments, that is. And so that just created a bit of a storm or potential storm if the assets themselves lost value or required further equity injections and so on and so forth, which is what we've seen over the last 2 or so years. And particularly challenged in the retail environment where they had retail investors, because ultimately, your doctors, your teachers, or so on in Seoul who may have invested in these things didn't have the ability to re-up their investment to plug funding gaps and so on.
And that's one of the big challenges, isn't it? They probably bought it thinking it's a 6 cap, but it's no longer a 6 cap. And then the value drops significantly. Tenants start leaving. Banks are kind of looking at it, and it might be an asset worth £200 million. It's now worth 120, which is the whole piece of their senior loan. And they're thinking, hang on a minute, how are we going to get around this?
Yeah.
Go back to the capital to say, can you re-up? Can you put some more money in? But if they syndicate it out to retail investors, as you said, doctors, teachers, lawyers, etc., just aren't going to be able to re-up.
No, and also they've lost confidence in the investment at that point. If they haven't been, well, they may not have been getting their distribution of their 6% that they were promised, but similarly, the value of their asset is practically zero in terms of the equity portion, and so they've lost confidence in the whole investment, and frankly, just simply won't invest anything further. So that's then leaves perhaps in some cases, the securities company who warehouse the assets, that leaves them potentially exposed to picking up the pieces from the retail investors, which then creates a burden for them, and has been very challenging. And that's why you haven't seen perhaps new deals with Korean backing in the market in the recent past. And I think, frankly, I would say, in my opinion at least, that securitization type model and syndication is something that won't happen again. And instead, it will be pre-raised capital in the fund structures in the similar way that we tried to promote and have promoted and delivered on in the recent past.
Yeah, it's really really interesting, and there's a lot of that that's happened across the press for those of you who are listening who don't have access to it or haven't read it. How can you just talk to me about the nuances or the cultural aspects of dealing with Korean capital? Because there's a lot of talk about Singapore or Japanese or Middle Eastern, each culture, US, each culture, they've got their own intricacies or ways of doing things. Can you just tell me a little bit more about, the mindset of a Korean institutional investor and kind of dealing with them as well from your perspective?
Yeah, absolutely. There are always those perceptions of different cultures. So I would say in my experience and why, I would work for a Korean-owned business, and then headquartered out of Seoul, is because of their diligence and hardworking, approach. I don't think I've ever encountered quite the work ethic that they have, and similarly, the attention to detail is quite frightening, and in some cases can be quite frustrating. But all of the questions that come, you realize the relevance that they have, and actually it makes you a better investor considering all of the different angles that you've been quizzed on and questioned on over the years. The other elements I would say, and of course I'm promoting working with Korean investors. I love it, and that's why I would want to do it in the long term, is a loyalty element, and I think that's not necessarily true across the board, but that's the same in majority of cultures. But certainly the guys who I work with very closely at Vestas, they've been there at that business since 2016. And the founder, of course, is still there, who's been there since 2012. So that gives some consistency. They've been very loyal to me and my team at Vestas Europe. And so I think that's another element that is sort of culturally a positive, absolutely. And then from an investment point of view, typically they do like names of businesses that are relatable. So I think one needs to remember that 5,000 miles away in Seoul, if you're investing in a building leased to a very local tenant, it doesn't give you the same confidence as if it's leased to a household name. So that's the sort of something that we've had to overcome to make sure that actually you're not paying a premium for the household name. You're actually fundamentally investing in good real estate that just so happens to be leased to somebody who you've heard of.
Yeah.
So that there are there's relatable elements, and I mentioned earlier that affiliation with the US. And from my point of view, I'm not sure whether my colleagues in Seoul would share this view, but I certainly think there's some US influence, and there's a like of the American way, and some people also have been educated in Europe and the UK particularly as well, and so there are some other synergies that work across effectively a Western society.
Can you just talk to me about your view on the market as it stands today? So we're sat here in kind of early mid-April, where the opportunities are across Europe too.
Yeah, everybody. Well, not everybody, but I'm sure a great number of people will come on and say beds and sheds. Yes, don't disagree. I think there is tremendous opportunity in the logistics space still. That's where, of course, I've got a specialism in the sector. So I would say that, but I do believe it absolutely. I think actually, I mentioned earlier the potential return of the big box. And it being in focus. And whilst, of course, today investors would prefer a deal volume of 30 to 50 million, and they may not be able to get themselves comfortable with 100 million that you may require for these bigger boxes. But they, for me, have operational efficiencies for the underlying occupier and actually deliver great income over a prolonged period. And I think we're going to see less supply over the next 10 years than we've seen in the prior 10 years, simply for practical reasons like availability of land and actually planning opposition to these bigger boxes. So actually, if you buy a fundamentally good asset in a good location that you could either have as a single let asset, or it doesn't stop you multi-letting it either, that's where I see actually today a good opportunity, and where you have potentially a bit of a pricing discount for quantum, which actually, if you go back to 2020 or 19, was the reverse. You were paying a premium for quantum because people wanted to get more money into the market, and they were under real pressure to deploy.
So what, like a portfolio premium to buying 3, 4, 5, 10 plus assets? They were paying a premium. If someone could aggregate a portfolio of assets,
exactly,
they pay a premium to that. Whereas now there's a discount to it.
Yes.
Can you just how and why is that the case?
Well, I think basically, of course, back in 1920 and so on, debt was free or cheap, and so getting the same amount of equity deployed and put to work, you were doing that. You'd want to do that in a bigger deal as possible, and you were able to generate the returns on the basis of the interest rate costs and so on. Whereas now your LTV may be lower, and debt isn't as accretive. And so those bigger deals, there just simply aren't as many investors there today, which for me is why that creates an opportunity perhaps for people to deploy into that space where there is still very strong market fundamentals and rationale for an investing into long income, but of course without perhaps quite so much competition.
You touched on there being a discount there, but also you touched on kind of brand names, and I guess the obvious one is Amazon, right? In terms of kind of global, or certainly from a European standpoint. How do you go around checking the creditworthiness of a tenant, or what makes a good occupier? Obviously, they pay their rent quarterly or what have you, but how would one kind of be discerning when making an investment decision over what is a good deal and what isn't?
I think you mentioned Amazon, and there are, and you asked the question about how one assesses covenant. There are, of course, credit rating agencies and so on out there, but I think that's all well and good. But frankly, there's no substitute for actually analysing the business and the financial statements of the underlying occupier, and also, there's no substitute for actually going to speak to them. It seems as if, quite often the case is that one would would just sort of go, well, there's the lease, that's the tenant, just take it as read. What we've always made a point of doing is making sure that we actually have a good understanding of our tenants' operations, reasons for being in that particular location, and so on, and why they've invested in the building and the location and so on and so forth. So it's perhaps not as binary as a credit rating on a piece of paper, which of course, that's a very difficult juxtaposition in a sort of fund concept, because you can't say, oh, I don't mind what the credit rating is as long as they've got a good reason to be in the building. So you, of course, in a fund environment, you need some, say, guideline in terms of covenant, be that they've got to have X number of million of revenue or turnover or whatever it is. But actually, when you come to discerning between what's good, what's bad, I think that human element is a big portion, and perhaps sometimes doesn't get the relevance that it deserves.
There's been lots of chat in the press about ESG and sustainability. Where does that kind of agenda fit in the kind of the pan-European shed market? Who's demanding it? Is it the capital? Is it the occupiers? Is it just good business? Where and how do you kind of see that? Or is it all of the above?
I was going to give you the annoying answer, which is all of the above, absolutely. But it's certainly being driven by investor and occupier, hopefully in equal measure. I think I'm not speaking out of turn if I was to say that some of our investors perhaps were a little bit slower on the uptake, but now have caught up, sped up, and perhaps even overtaken some counterparts because of the focus that is on ESG, quite rightly. And so, and combine that with the point I made earlier about, tenant engagement, working together collaboratively with occupiers alongside willing investors has to give you the right solution, or at least take you on the right path to the right answer. What the right answer is, don't know, and I think there is still some evolution as to what the EU taxonomy looks like from an ESG point of view, and we're still on that journey. But there are many bright minds set about fixing that and giving people some clarity. But it is an absolute must on all new investments, and it's an absolute must in terms of enhancement of existing.
I guess the point around protecting value as well as increasing value, especially in this type of market, right?
Yeah, absolutely. And I didn't really allude to it earlier, but one of the main reasons as to why the guys in Seoul wanted to establish Vestas Europe was very much for the protection of value of the existing assets in the portfolio, of course, in partnership with our existing asset managers. And ESG and learning trends in the local market is a big part of that protection of value that perhaps if you were one step removed and just had the team in Seoul, maybe you wouldn't have so much exposure to.
Can you just give me a bit of an overview of the team in the UK, and then also what your plans are in terms of kind of the future as well?
Yeah, of course. So there's 4 of us in the UK today. We think the base is covered in terms of, we've got debt, tax and structuring, we've got portfolio, asset management ongoing, and a bit of market facing, both from, sourcing new transactions, execution of deals, but also talking to a variety of capital. And that, as you allude to, is, part of the future plans. So the reasons for Vestas' establishment, I've touched on establishment of European platform. I've touched on the protection of value for our investors, which was, pillar number 1. Pillar number 2, of course, as and when the right time to grow the AUM is there, then we are here and we're ready to do so, to support our investors in their ongoing ambitions for returns. And then latterly, we have ambitions to grow Vestas Europe with the existing portfolio into a bona fide investment management platform to include some different capital from other parts of the world. And that could be either by way of our own separate accounts that we discussed earlier, but also perhaps in JV with some of our institutional investors from Seoul, where there are some synergies from capital from other parts of the world in terms of, risk profile, return requirements, and so on and so forth. So JVs with our existing well-established relationship partners from Seoul, together with some other pots of capital from around the world, is certainly something that we would like to grow.
So you've got the ability to be flexible and could be market or deal or investor led, or however you want to kind of structure things. There's that inherent flexibility built in there, and then kind of room for growth from a headcount to accommodate that in due course as well.
Yeah, absolutely. We've got 12 desks in the office, so we're ready for growth.
Well, look, as we draw to a close, Alistair, a question that I ask everyone that comes on the podcast is, if I gave you £500 million worth of capital, who are the people, what property, and which place would you look to deploy that capital?
Very good question, obviously. As I mentioned earlier, I would certainly have a logistics, big box, income type strategy. Perhaps that's my income element. But I'd also want to supplement that with some growth. And I think, there'd be some forward funding type structures, again, most likely in logistics, but that's our, sector specialism, I guess, or mine at least. So I'm a bit biased in that respect. I think hospitality, operational business type is an area where there is great opportunity. I personally don't have sufficient experience, maybe, but I know there's some great partners out there which could take a portion of my 500 million and put it to very good use. And finally, I would say the alternatives. So some data centers, maybe a little bit of infrastructure, those types of sectors, which is ones that our Korean investors are very keen to explore, including energy transition. So be that, fossil fuels to electric or hydrogen, depending on the route of travel. But what's quite nice, or potentially could be quite nice, is the logistics synergy with some energy transition. But, that's all a bit, blue sky thinking, but certainly those are the areas I'd go for.
There's an angle there, and also with data centers as well, within, I guess, repurposing or repositioning sheds. Well, look, you've had a fascinating background. I really enjoyed finding out a little bit more about the business, how you see the market and the opportunity, and excited to see what you and the team go on to do.
Well, thanks for having me again, and it's been a pleasure.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show, or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.